Okay, let's go ahead and get started. Actually, we got a few more that'll join us, but I was going to go ahead and get started with the content so we can keep everybody on their timeline for tonight. Again, my name is Jason Maida, in case you missed my introduction earlier. Really, it's great to have you as part of our Bay Area Homebuyer Workshop. We get a chance to teach these workshops throughout the California markets, generally once a week. So we focus on areas like the Bay Area or the Sacramento market, maybe LA or Orange County. So hopefully you enjoy the information we're going to share with you this evening. If you do find it informative and a great resource for you, we really encourage you to invite friends, family, maybe colleagues that might want to enjoy listening a little bit more about what home buying looks like. And there's so much to talk about in the marketplace right now. So hopefully you guys find this information really helpful for you on your journey towards home ownership. A little bit about me. So I've been in lending just over well over 20 years, I should say. And we specialize in first-time home buyer programs and just kind of really providing support and education to first-time buyers. And hence, that's why we do a lot of these classes. So we're specialized in the CalHFA assistance program, really great tool to help first-time buyers. You're going to learn about that this evening. But we also do all types of programs, conventional loans, FHA, VA, jumbo loans, which especially for our clients in the Bay Area markets, one of the more used products. So we'll talk a little bit about all that this evening. Some of our topics for this evening, we're going to look at the housing market, lots to talk about there. We're going to look at does buying make sense? I'm going to take you through a budgeting calculator in just a few, look at credit, how we interpret student loans for qualifying, different loan programs that are available to you, qualifying income, some of the assistance programs offered through CalHFA. And then we'll also talk about the loan process. We call that the 6 steps of home buying. And then I'm going to take you through what a personal consultation looks like. We help design a home buying game plan for you, so to get you on that path towards home ownership. So we'll help kind of devise a plan for you. Okay, so a lot of great things to share with you this evening. If you didn't catch it earlier, I really encourage questions as we roll through tonight's content. So if there's some information that you want to hear from me or want me to share with you on tonight's session that's not in our slideshow, we'd love to be able to present that to the group. So when we think about home ownership, and for all of us joining tonight's call, I mean, this is probably going to be one of the biggest investments you make in your lifetime. So taking the time to do your research and really understanding what it could look like for you to buy is a big thing. And so joining a class like this will hopefully give you the tools that you need to be able to make that great decision. And the benefits that come with home buying are significant, right? So it creates the ability to have stability in your housing payment, the ability to be able to pass along the asset to the heirs of your estate, growth in equity. When you think about how much you owe on a house versus what the market appreciation or the new market value is, that difference is appreciation or equity. And there's potential tax benefits that come with owning a home. So a lot of great things that come along with buying, especially our clients that have bought over the last 2-3 years with this crazy housing market. They've seen just massive increases in value, 15 to 20% year over year. So now, do we see that forthcoming down the road? We'll see what happens in today's market, but nonetheless, there's a lot of value that comes with owning a home. So as we're preparing to buy, though, we got to kind of really figure out our budget as to what it could look like in our comparing our current rent situation versus buying. So to launch us off into tonight's discussion, I want to take us through a calculator. It's called the Freddie Mac Rent versus Buy Calculator. And we're going to go through just a quick scenario to see what it could look like to continue to rent and go down that path versus what it could look like to buy. By the way, all the material that I review with you this evening, we're going to share back out with you tomorrow morning. So you'll get all of our copies of our slideshow so you can use that as a resource for yourself. Okay, so let's go ahead and plug in a few numbers here. So we're going to start with rent. And I know this is going to vary based upon where you decide to, or where you do live today. Whether you're in a rent controlled area like maybe San Francisco, or maybe you're in Oakland, maybe you're paying $3,000 or $4,000 a month. I'm going to plug in $3,500 a month. And I know that may be higher or lower for some of you that are joining tonight's discussion. Home purchase, that will vary based upon where obviously you decide to purchase. I'm going to go ahead and plug in what most of my conversations are like with some of our first-time Bay Area buyers. So we're going to assume maybe a purchase price right around $800,000. Now you're going to learn a little bit more about loan programs in just a bit. The minimum down payment when we're at that level of purchase price is usually 5%. Now I know if you talk to some of your friends, maybe coworkers, they probably said that 20% down was the minimum, but you can actually put as little as 5% down on some of the higher priced homes in the Bay Area. You're going to learn a little bit more about what those loan amount levels look like in just a bit. Property taxes on maybe an $800,000 home purchase, closer to about $9,600 a year. And then we're going to make some assumptions around homeowners insurance. We'll put this up just a smidge to $1,200 a year. Now, when we factor in our budget, we also want to take into consideration maintenance. So we're going to plug in $2,000 in maintenance costs. And then for the loan information. Now, usually first-time buyers, 95% of our first-time buyers are going to utilize a 30-year fixed mortgage. So we're going to put that as our term for today's discussion. And interest rates, average interest rate is really skyrocketed up over the last couple of months. Average interest rate is probably pushing closer to 5 to 5.25. I'm going to leave 5% in here just right now for our discussion. And then origination charges are how much your lender will charge. Now, usually with our financing that we set up for our clients, we have a $910 processing fee and a $995 underwriting fee. So that's part of your origination charges. Now, if you're joining us through one of our alumni partnerships, we do discount some of our services by $750. So we'll learn a little bit more about that later this evening. And then discount points, those are going to be the costs that you can pay in additional closing costs to help buy down your rate. What a point is equivalent to is usually 1% of your loan amount. So if I'm financing, let's say $780,000 and I pay 1 point, that would be $7,800. That helps me to lower my interest rate. Usually when you pay 1 point, it can typically lower your interest rate 0.25%. It'll change based upon the pricing models for different lenders, but generally that's what it looks like. And then other settlement charges are going to be also known as closing costs. When we look at closing costs in our savings, not only do we have to save our down payment, but we also need to save closing costs. And generally speaking, they're about 2 to 3% in total of your overall purchase price. So I'm going to put, for just this discussion here, we're going to put in roughly about $12,000, and then we'll, of course, you also have your lending costs. All right, the other assumption we're going to make here is appreciation rate. We have in 3%. As you heard me speak earlier, we've seen some appreciation rates as high as 10, 15% year over year, even higher in other parts of the market. Expected years in the home, we're going to put 7 years. The selling cost at 8%, what that translates to is when I sell my home at the end of 7 years, there's going to be costs incurred. And those would be the costs of utilizing realtor services for both the listing agent that sells my house, but also for the agent that brings the buyer to my home to purchase it. So those are part of our overall closing costs. So we're going to budget for 8%. That might be a little bit high, but let's assume that. State and federal tax rate, and then the savings rate. Let me jump back really quick to the selling costs data point, because as a future buyer, when you have representation of a realtor, that's paid for by the seller. So we always encourage especially our first-time home buyers to utilize the services of a realtor, because they're going to be experts, hopefully, in the market. They'll be able to help negotiate the purchase price for you. So really encourage you using those services. So when we plug all that information in and we kind of put side by side, if I continue to rent, my rent we know is about $3,500. Now my mortgage payment is closer to $5,700. So we're looking at, what about a $2,200 difference? However, over 7 years, if I was continued to rent versus buy, my opportunity over 7 years is about $108,000. Now that'll obviously vary based upon our housing budget for our current rent situation versus what kind of house we're looking to purchase. But nonetheless, as you can see, definitely skews to more favoring on the buy side, based upon the current market. Now, one of the big things we talk about with clients is, figuring out what does that affordable payment look like for you? Because for some of us to jump up from, $3,500 to $5,700 is a bit of a stretch. So we may have to figure out how we can recalibrate things, maybe with more down payment or lesser purchase price to be able to make that mark. Okay. So that's our rent versus buying calculator. Let's go ahead and jump back into our slideshow. And now I want to kind of transition a little bit and talk to you a little bit about the housing market. So obviously, for those of us that live in the Bay Area, the housing market is a bit crazy. It's not any easier in the Bay Area for first-time homebuyers, especially. And when we look at what's kind of leading to what's going on in the Bay Area, obviously huge demand from the buyer side, limited inventory out there. So we have high demand, limited supply, really pushing up prices. And this kind of upward movement is not different than any other markets that we service in California. This gray line represents the start of the pandemic. And obviously, as we enter the pandemic and the change in employment situations where more clients are working remotely, and so different markets, housing markets were impacted because of that. Maybe some of our Bay Area clients were looking to move to Sacramento or maybe the foothills just because they didn't have to be in the Bay Area. So we saw some of our outlying areas like Sacramento start to see a big push up in appreciation. But also the Bay Area housing still remained really super strong, even though we did see some changes in maybe clients that are working for Bay Area employers, but going outside the area. And, I think really what we're seeing here in the Bay right now is just lack of inventory and just not a lot of new home opportunities either out there. And at some point, we hope this line will kind of level out a little bit to make it a little more of an even playing field from our first-time buyers. And I think we're starting to see a little bit of that right now. It'll be interesting to see with our change in interest rates, kind of how this market maybe levels out a bit. Because what I have noticed as I consult with clients and talking to some of our preferred realtors is that we are seeing some softening out there. And what I mean by that is maybe sellers that are a little bit more willing to negotiate. We saw over the last couple of years really ridiculous terms skewed more towards the seller to help the seller versus the buyer, and it made a little bit more of a pressured sale for some of the buyers out there. So we're hopefully seeing maybe more of a level playing field to help on negotiations for buyers. But then what I hope that we'll see is maybe a little bit more inventory entering the market, more sellers now willing to put their homes on the market because they're seeing signs of higher interest rates. So that'll hopefully give more opportunities for our buyers entering the market. Okay, so that's what we see on the housing market side. Now, one of the big topics right now is interest rates. Over the last couple of months, we've seen interest rates increase over basically 1.5%, 1.5%. The average interest rate is anywhere between 5 to 5.25, just depending on the day. We've seen super volatility in the markets. And you can see in our slide here, the blue line represents the 30-year fixed mortgage. And, ever since, really February of this year, we've seen just a really fast move upward on the 30-year fixed mark. And, obviously that's changing purchasing power for a lot of our buyers. So for some of our current pre-approved buyers, we're having to kind of go back and renew their pre-approval, talk more about affordability and monthly payments, and really see what that looks like for them, because in some cases it changes things dramatically, maybe $200 or $300 a month. So as we're hopefully at one point building a home buying game plan for those of you attending tonight's call, we'll be able to look at current market rates and be able to really determine what's a good affordable purchase price level for you. But nonetheless, the 30-year fixed mortgage rates moving upwards has impacted qualifying for some of our first-time buyers. Now, the question is what's leading to higher interest rates? Well, as you probably have seen in the news, inflation rates have really gone through the roof. I think we're at 40-year highs in inflation right now. And so food costs are up, gas prices are up, and interest rates have obviously pushed up as well. So we'll see where that goes. There's kind of some talk around maybe if we enter in a recession, what's that going to look like? The guidance we're giving our clients right now that are currently shopping for homes and eventually going to have an accepted offers, we're going to probably try to lock in that interest rate right away, because the market remains very volatile right now. So we'll see kind of where that goes with interest rates. Now, when we look at our interest rates offering as a buyer, not all interest rates are the same for all clients, because it varies by credit eligibility, the type of loan product you're doing, how much you finance, how much you put as your down payment. If you decide to pay those points that we talked about earlier, so that additional costs that you can pay to bring down your rate, and the term. So typically when you have a shorter term of loan, the lesser interest rate you're going to have. Generally speaking, if you went from a 30-year fixed mortgage to a 15-year fixed mortgage, it's about a 0.5% difference in interest rate. Now, one of the topics that comes up quite a bit, I'm going to kind of go off slide here for a little bit because it's kind of really has to do with what's going on in the market right now. So when we're in a rising rate environment like this, especially in some of our high cost of living markets, more clients will ask us about adjustable rate mortgages over 30-year fixed mortgages. And as you can see in this slide here, and if you guys look at the orange line here, that represents an adjustable rate mortgage, which is the 5-1 fixed arm. So it's fixed for 5 years. I don't recommend adjustable rate mortgages for first-time buyers because it creates too much unpredictability in the future. But why that question comes up a bit, because people believe that just because interest rates are higher on a 30-year fixed, that adjustable rates are going to be so much lower. And as you can see by this kind of representation, we see kind of the 5-year falling really closely to what the 30-year fixed is doing. Now, going back into 2014, 15, there was a pretty good gap here, so it maybe did make some sense. But short-term rates just aren't much better than what we see in long-term rates. So it just doesn't justify the risk and the potential volatility down the road. So as you're looking at home buying and maybe friends, family, or coworkers are talking about adjustable rate mortgages, they're just not there yet. And I think just as first-time buyers, it probably not going to make sense. Okay, so one of the components to qualifying and optimizing your interest rate is going to be credit. So during our classes, we like to kind of teach a little bit about credit, some tools and some resources that can help put your credit in the best possible position for buying. The good thing is there's a lot of great credit tools that are available to you as consumers. And so most of our clients that come to us have some idea of what their credit score looks like, but it's our job to kind of provide even more guidance and maybe a credit game plan to get them on track to have the best available financing. So the FICO score calculation is here, and this kind of shows the weighting of credit scores. So 15% is going to be how long I've had credit, 20% is how much new credit I'm putting in use. That's also including hard inquiries, so those could impact your credit score. 30% is going to be how much credit I have owed right now, but more so that's utilization of credit. So when we think about utilization, that's going to be for revolving credit. So for example, if I have $5,000 in credit balances and I have a $10,000 credit limit, that means I'm at 50% utilization. The bureaus are going to look at that utilization in an aggregate form, so taking all of your credit limits and credit balances, and that's where they come up with the utilization rate. Now, one way of managing your utilization, which seems to work pretty effectively, is when you're looking at your credit balances, and let's just look at that example of the $5,000 credit balance. With a $5,000 balance and a $10,000 credit limit, I'm at 50% utilization. Ideally, you want to be below 10% utilization. So I want my balance at least below $1,000. And for some of us, just trying to get our a hold of our finances, maybe that might be a little bit of a stretch to get below 10%, but that would be kind of our big goal, is below 10%. If we're kind of just running around 70 or 80% utilization, we want to try to push below 50%. That's kind of what our goal would be. Now, when you're managing utilization, and I would encourage you guys to take a look at this offline after tonight's discussion, take a look at your billing cycle date on your credit cards. The billing cycle date is the date at which the credit card issuer is going to post the balance to the credit agencies. And the due date is going to be obviously the date that you're supposed to pay your particular credit card. What I would encourage you guys to do is, if you can, try to pay down or pay off your credit balances before the end of the billing cycle, because if you can catch and pay down that balance to a certain level before the end of the billing cycle, that is the balance that'll post out to the credit bureaus. So if my billing cycle is on the 20th, my due date's on the 5th, as long as I pay off that or pay down that balance by the 19th or the 18th, that whatever that remaining balance is, that's what will post to the bureaus. Okay, and that's a great way of trying to optimize your credit score. Now, with payment history, that's going to be past maybe challenges we've had with credit. So when you have a late payment, it records in 30, 60, and 90-day lates. And based upon the date of the last event of the late payment, that's going to be the most impactful to your credit score. So if you had a late payment 12 months ago, it's going to probably hurt your score a lot more. But as you get further away from that, typically outside of 2 years, then you'll see a little bit of improvement in your credit score. So bankruptcies, maybe short sales, collections, late payments, those are all obviously past challenges that can hurt your credit score. Account closure is something we want to take a look at as well, because if you're in the habit of maybe moving credit cards and doing balance transfers to get better benefits, but then you close out the old credit card, you just want to be careful with that, because it could impact this 15% weighting, which is your length of credit. Because we want to make sure we have a good, seasoned, mature credit file. And if I close out a credit card that's been my longest standing account, I could hurt my credit score, because there's two things that could happen. One is I lose my longest standing, most mature account, so that impacts that length of credit. But also, if I pull out another credit limit, it could negatively impact my utilization rate as well. For lenders, as we evaluate qualifying, we're always going to look at the lowest credit score for any of the borrowers that apply. Now, if you're applying individually, we look at the middle score. So let's say I'm at a 720, 700, and 680 credit score. We use the 700 credit score for qualifying. So if I'm at a 700, but then let's say I add my partner to the application and my partner's 680, 660, and 640. Now my partner has the lowest middle score between the two of us. So we can't use the 700 credit score. We're going to use the 660 credit score for qualifying. Okay, so that comes up quite a bit as we're consulting with clients. Now the minimum credit scores for each of our our core products are 600 for an FHA loan, 620 for conventional, and 620 BA. And then you're going to learn a little bit more about CalHFA, the California Housing Finance Agency program, in just a bit. Just to kind of wrap up with credit, this is a kind of a matrix to show you how long negative items will stay on your credit. So hard inquiries are going to be 2 years or less. Late payments will be 7 years. The impact is generally in the last 2 years from the event, but they'll stay on your credit report for 7 years. Bankruptcies are 10 years. Delinquent debt will be generally 10, will be on there. Delinquent student loans, any federal tax liens, those can be on your credit report indefinitely. Just to really kind of back up a little bit, talk about inquiries. So hard inquiries are what can hurt your FICO score. Now, when you apply for a mortgage, you do have a 30-day window of time to apply with as many lenders as you want. So if I get my credit inquired today, that starts day one. I have 30 days to apply with as many lenders as I want. And that's the equivalent of one credit inquiry hit to my score. Now, in working with our team, so if you decide to move forward with us to look at different home buying options, we start with a soft credit pull. So that allows us to do a consultation with you without impacting your credit score and starting that 30-day clock. So kind of dovetailing off of credit a little bit, I want to talk to you a little bit about student loans, because for probably 90% of our clients, they probably have some type of student loans. And so it impacts the overall qualifying and the positioning of your financing. So when we look at options for you to qualify, there's kind of two different lenses we put on student loans, and they're based upon the guidelines of each product. So generally speaking, for first-time buyers, we're either looking at a conventional loan or an FHA loan. With conventional loans, let's show you an example. So if you had $75,000 worth of student loan debt, the default is going to be 1% of the balance is going to be your payment, which would be $750 a month. However, if you're on an income-based repayment amount, we're going to take the income-based repayment for qualifying. So in this case, it would be $250 per month. Now, I know for all of us, you have an extension of your forbearance because of the CARES Act. So there is no payments due right now. But if you're looking to qualify for a mortgage right now, we still would have to use the payment that you qualified for prior to the pandemic. So if I was on an income-based repayment amount of $250 prior to the pandemic, that's what we're going to use to qualify. For FHA loans, it's a little bit different. The default is 0.5%, so half of that amount. So default is $375 on that same $75,000 balance. But the same thing holds true if I'm on an income-based repayment amount and it's $250, then that's the amount we're going to use for qualifying. Now, beyond forbearance, if you're in deferment or you have a forgivable loan, anything like that, we still have to count a payment against you for qualifying. Even if you're back in school, maybe you're finishing up your master's program, we still have to count a minimum payment for you using this calculation for qualifying. Okay. And we can go back to student loan calculations if you have any questions. It usually comes up quite a bit as part of our workshops that we teach. Let's talk a little bit about the loan programs. These are kind of the five core programs that we offer for clients. So the first program is a conventional loan, which is pretty typical for our first-time buyers. You can put as little as 3% down on a conventional loan up to a loan amount of $647,200. And for our Bay Area market, when we go beyond $647,200, the minimum down payment jumps from 3% to 5%. Okay. Minimum credit score on a conventional loan is 620. And so with that program, we're going to talk a little bit more about guidelines in just a second. I want to also do a kind of a quick comparison of conventional versus FHA. Speaking of FHA, the minimum down payment is 3.5%. Now, there is no differentiation between that $647,200 loan amount and the very top loan amount, which is $978,800. So it's a 3.5% down payment all the way up to that amount. For VA loans, there's a no down payment requirement, minimum credit score of 620. You can go up to $1.5 million right now in VA loans with zero down payment. And those are obviously for our veterans that have served and have that eligibility. USDA is a zero down payment up to a loan amount of $978,800. USDA stands for the United States Department of Agriculture. So they are geography specific. So you have to be in a USDA located area. And so we have a way of kind of calculating that for you. They also have minimum or maximum income limits for the household. So those have some criteria that we have to meet to be able to qualify for USDA. And jumbo loans, which are a little bit more frequent in our Bay Area markets, not as much for first-time buyers, but it does happen at times. It's a minimum down payment of 10 to 15%. The FICO score requirements will vary by some of the program offerings, but usually it has to be at least a 680 credit score. Now with jumbo loans, there's another requirement for your asset position. So as we kind of learned just briefly earlier, we have to save up for our down payment, our closing costs, and that's kind of what these core programs require. However, with jumbo loans, there's an additional requirement. It's called reserves. And reserves are usually 12 months equivalent of your monthly payment for the loan. So let's do some easy math here. Let's say I have a $5,000 monthly payment. My reserve requirement is 12 months. I would have to have $60,000 in assets that are either in my 401k or my checking and savings account that are left behind after I've contributed my down payment and closing costs. Now it's just assets that are left behind. They don't get contributed to the transaction, but it's the ability to be able to show a little bit more stability and liquidity when it comes to qualifying for these types of loans. Okay, so that's on a jumbo loan. Jumbo loans can go up into the multi-million-dollar levels. And now, of course, if that's something you're looking at as part of your home buying game plan, we can certainly kind of figure out what options make the most sense. I want to jump back to talk a little bit about conventional loans and FHA loans. And we're going to look specifically at private mortgage insurance, or PMI. And PMI comes into play when you have less than 20% down. For conventional loans, it's the mortgage insurance is based upon your credit score, how much you put down, and how much you finance. And so there's different options in how to elect conventional mortgage insurance. It can be paid monthly. It can be split up between monthly and then some type of upfront fee. It can be paid all up at front, all at front, called a single premium. And then there's lender paid MI, which doesn't happen a lot, where you can increase your interest rate to buy out the mortgage insurance. In an appreciating market like this, we're very rarely going to do lender paid MI. But in some cases, some clients, it does make a little bit more sense. Now with conventional mortgage insurance, it will have usually has a cancellation option. So once you have 2 years in the home and 20 to 22% equity, you can apply to have the mortgage insurance canceled. Now, when we compare conventional mortgage insurance versus FHA, there's quite a big difference from an expense perspective, because with FHA mortgage insurance, the monthly premium is going to be based upon 0.85% of your loan amount. And then we divide that by 12 to come up with our calculation. And then upfront mortgage insurance is included, which is 1.75% of the loan amount, which gets tacked onto your amount financed. So you finance a little bit more. So when we look at the differences between these two programs, conventional mortgage insurance, let's say we finance $450,000, that premium would be about $183 a month, versus FHA would be like $324 a month. So a pretty big difference there. FHA mortgage insurance does not have a cancellation option. The only way you can cancel it is if you refinance into a different loan product. Now, when I talk with clients throughout the day, one of the things I hear quite a bit is when you're doing calculations like on Redfin or Zillow, those mortgage insurance premiums look pretty significant higher than what we're showing you here in our example. That's really because a lot of those online tools that you have available to you don't factor in your credit score or down payment and loan amount. They're kind of just a carte blanche monthly amount. So just something you want to take a look at. Our calculator that we offer that you're going to see a little bit later on, it's a little calibrated a little bit better, so you get a better closer payment. But I think the takeaway here when you compare conventional versus FHA is, first of all, with FHA, it's going to be a little bit more lenient from a guideline perspective, especially on past credit challenges. So let's say I've had a bankruptcy that was 3 years ago. That would be allowed with FHA, versus conventional would want us to see out of a bankruptcy at least 4 years. Or let's say I had some challenges with my student loans and they went 90 days plus delinquent, 12 or 12 or 24 months ago, FHA might maybe okay with that, where conventional might be a bit more prohibitive. So, it's not, like I said, a one size fits all for all clients. We want to customize a home buying program that makes a little bit more sense for you based upon your eligibility and kind of where you want to go with your home ownership goals. These are the conforming limits for this year in our Bay Area market. So as you can see, San Francisco, Marin, and San Mateo are all the same, along with Santa Clara and Contra Costa. So there's not a lot of deviation there. If you get into Solano, for some reason, Solano is just a much lower loan limit. It's based upon median income level when they set these income limits. Hopefully at some point we'll get Solano to change because, and hopefully we'll see that this coming year for 2023's limits, but that's always typically been a little bit lower. And then Sonoma County 764, 750. If you're joining us from the Sacramento market, Sacramento is at 673, I believe. I'm sorry, no, 698 this year. So we can send you those limits as well if you're looking in the Sacramento market. Okay, let's talk a little bit about some of the documentation required as it relates to income. So we call it our qualifying income section. So as W-2 wage earners, it's pretty easy. Last 2 years of W-2s, last 30-day pay stubs, really easy. And then we're going to do some type of verification of employment, whether that's written or verbal, probably a combination of both. If you're self-employed, we're generally going to need 2 years tax returns, profit and loss statement, and then we're going to have to verify the business through either a business license or maybe a CPA letter. So it can get a little bit more complicated if you're self-employed. And so that's something, we want to kind of prepare ourselves. Now, jumping back to W-2 wage earners, and really even for self-employed individuals, typically you're going to need to have 2 years of work history for employment. So doesn't mean 2 years on the job for our W-2 wage earners, but 2 years work history. And or education. So why that's important, if you're joining us and maybe you just started in the workforce because you just graduated, if you have, let's say, 4 years of undergrad completed in an accounting degree and you just graduated in the fall and you're just starting your accounting job this year, even though you're new on the job, with the past education and now entering the workforce, that would satisfy the 2-year requirement. So a lot of clients don't realize that you can still use your education if you're newly entering the workforce. Another thing that comes up quite a bit is just time on the job. You don't necessarily have to have 2 years on the job. You can be starting a new job, and that new qualifying income can be used for the qualifying of your mortgage. Now, if you're working dual employment, so we see this often in the healthcare industry. So if you're working at multiple, say, hospitals, you do have to show that you've been on both jobs consistently for 2 years. You have to demonstrate that you can hold down 2 positions simultaneously for a 2-year span of time. If you're a W-2 wage earner and maybe you do Uber on the side, we can certainly use the Uber income, but you just have to demonstrate that you've been doing at least 2 years if you want to also include your W-2 wage earner job. Okay, so those are some of the things that kind of come up. One other thing that we get is just job transition. So like we'll have clients that are going through their pre-approval process and they mentioned to me that, hey, I got a job offer, I might take it. They asked me if if that income is higher, can we use that for qualifying? The answer is yes. So as long as we have an executed offer letter, we can potentially use that for the qualifying on the new mortgage. Okay. All right. If you guys need me to go back to the income section, we can certainly talk about some different scenarios that'll come up in the Q&A. So, all right, staying with income, there's a calculation that we use as lenders, and it's called debt to income ratio. And what that does, that takes your pre-tax income versus your monthly obligations. Those obligations include personal loans, credit cards, car payments, student loans. Those all get factored into this calculation along with your principal and interest, taxes, insurance, your mortgage insurance on the new property purchase. And we generally want that calculation to have you at a 43 to 45% debt to income ratio. So that means no more than 43 to 45% of your pre-tax income is going out to those expenses. Now, that number doesn't necessarily show us affordability. Affordability is going to be based upon really kind of what feels good to you versus your total rent payment versus what you think a good level is at for your monthly mortgage payment. We want to make sure that we're setting ourselves up to succeed with homeownership. And so debt to income ratio is more of a qualifying number versus more of an affordability thing. Here's the calculation for debt to income ratio. So it's the principal and interest, the property taxes, the homeowner's insurance for your new house. If you put less than 20% down, PMI, private mortgage insurance, And then if you're purchasing a condo, maybe a townhouse, HOA or homeowners association dues. So let's say that was $2,500 a month, and then you have other expenses of $500 a month. If we take that $3,000 in expenses versus my $8,500 in income, then my debt to income ratio is about 35%. As I work with clients on a daily basis, the debt to income ratios where clients feel most comfortable is about 33 to 36%, but everybody's situation is a little bit different. And so we would, encourage you to, have that conversation with us to make sure we're designing a plan that makes most sense for you. Okay, so far we've gotten through our class. We've talked a little bit about, the market, interest rates. We've learned a little bit about credit, some of the basic program parameters. And when we look at buying a house, we want to look at credit, assets, income. And we're going to talk about assets now, because assets are going to be what we're going to need for our deposit, our down payment and our closing costs, possibly reserves if we go the jumbo loan route. So there's a few things that are really important for us to know about assets when it comes to utilizing those for financing. Generally, we're going to want to see 60 days of statements of your accounts. We can't use cash deposits because everything has to be seasoned and paper trailed for the financing. Large deposits, we just need to find out where they're at. A lot of our clients are getting maybe tax refunds right now, so obviously we could paper trail that. But if there's a mysterious, $10,000 deposit that just comes in the account, we have to make sure we know the origination of that, because everything has to be sourced as part of the Patriot Act. Now, 401ks, 403bs, IRAs can all be used. If you're going to access maybe IRAs, you want to make sure you talk to your tax professional or maybe your financial advisor, because we want to make sure that we don't create a tax liability for yourself. Okay, we had a question that came in on assets, and just more as a question around can we bring in cash from India or like out of country funds, I guess. So you could bring the cash in and transfer it. It depends on, we say cash, if it's coming from another financial institution in India to the United States, that money can be used, and we just have to do the conversion, and we can, as long as that's seasoned in the bank account in India, that's fine. If it's truly cash, that would have to be deposited into a U.S. account, seasoned for 60 days, and then potentially be used for the purchase. Okay, hopefully that helps. That's a good question. That does come up often. The other thing that can be used in home financing is gift funds, where a family member is helping you out with funds for your purchase. And so those don't require any type of seasoning. They just, it's something where we would provide the donor a gift letter. They would document how much they plan on gifting. They have to show us proof of that they have the actual asset, and then they would transfer the funds to you. Okay. Now, gift funds can also come in the form of gift of equity. That's a little more complicated. It, in essence, means that a family member maybe is going to gift you a portion of their net proceeds to be able to fulfill your down payment and closing cost requirements. That doesn't happen often. We very rarely see it, but when we do, it's something that is acceptable for lending. Okay, so I want to kind of continue on our conversation around assets. And, when we look at, first-time homebuyer options and some maybe the challenges that first-time homebuyers face, I usually hear kind of two things. One is it's maybe credit, because maybe credit is not in the best possible position, or we have excessive obligations. But more importantly, we hear that we just don't have the resources for some of the requirements for down payment and closing costs. In our Bay Area markets, the average first-time homebuyer probably needs about $30,000 to $40,000 to purchase. And if we're just trying to get our financial kind of footing right now, it may be a little bit challenging. And so in partnership with CalHFA, the California Housing Finance Agency, this can be a fantastic resource to be able to help you achieve homeownership that much easier. And so what the agency does is it provides assistance for both your down payment and closing costs in home buying for low to moderate income households. And you'd be surprised at how I guess lenient the income limits are for these programs, especially in our Bay Area markets. Just last Monday, we launched the Equity Builder program from CalHFA, and you're going to learn a little bit more about that in just a minute. Let me share with you first about some of the core products that are offered with CalHFA. There's the My Home Assistance Program, provides up to 3 to 3.5% of your purchase price. The 3% is for a conventional loan, 3.5% is for FHA. Now, if we're going to be buying those higher purchase price levels, let's say the down payment is 5%, then you would get 3% towards that 5%. There is no maximum asset requirement, meaning if I have plenty of assets saved for my home purchase, doesn't disqualify you from the first-time homebuyer program. Now, it is a low-interest loan at 1% interest, simple interest, and you don't have to pay it back until you either sell your home or if you refinance in the future. Okay, so that's the My Home Assistance Program. That helps with just your down payment. Now, with the closing cost side of things, there's the ZIP Assistance Program. That's a zero-interest program, and it provides anywhere between 2 to 3% of your loan amount interest-free. And that also is not required to be paid back until you sell the home or if you refinance. Now, you do have to start with the My Home Assistance Program. So if you want to take advantage of that, it's great. And if you want to kind of add on the ZIP Assistance, you can do that. You can't start with the ZIP without starting first with the My Home Assistance. So we can move those or put those programs in tandem. So you get your 3% plus your closing costs, and that helps to reduce that lower amount out of pocket. So when I mentioned to you, maybe without assistance, it's 30 to 40,000 out of pocket. Maybe we can get that down to maybe 10 to 15,000. Now, this is the program that just launched last Monday. It's called the Forgivable Equity Builder Loan. It's designed to help low-income households. And, you know, in the Bay Area market, you'd be surprised at what the area median income level is. So like in San Francisco, if you make 106,880 or less, you're considered low-income housing. And with that, you would have some eligibility for the Forgivable Equity Builder Loan. And the way it works is you get up to 10% of your purchase price. So let's say it's an $800,000 purchase price, you would get up to $80,000 in a combination of down payment and closing cost assistance. So we can figure out how we would want to use that. We could put all at $80,000 towards our down payment, or a portion towards our down payment and some towards our closing costs. What's cool about this program, it's a forgivable loan as long as you stay in the property for 5 years. Now, it can't be combined with the My Home or the ZIP Assistance. It's completely separate. But it's such a great tool to help out, especially our Bay Area first-time home buyers, because you know that is a big challenge to be able to have enough in assets. The core My Home and ZIP Assistance programs are great, but they don't help quite make the mark because there tends to be a significant amount still owed. Now, the Forgivable Equity Builder Loan can go with either the FHA loan or the conventional loan. And so it can be, like I said, just a fantastic resource for you. Let's take a look at a scenario of kind of a calculation here with the program. So if we looked at, let's say, an $850 sales price in the Bay, the minimum down payment is going to be 5%, which is $42,500, plus your closing costs anywhere between $17,000 to $25,000. So we would probably need about $59,000 to $67,000. However, if we use just the core program of My Home Assistance and ZIP Assistance, I can get ineligible resources like $41,000 to anywhere to $49,000. So instead of putting that large amount of money out of pocket, maybe I'm putting $18,000 to maybe, you know, I don't know, $17,000 out of pocket. That really helps lessens the burden of trying to get into home ownership. And that's through the CalHFA Assistance Program. You can also, that's a conventional option. There's also the FHA option as well. And those cash out of pocket options look very similar. Now, there is eligibility requirements for both the forgivable loan as well as for the core assistance programs. Minimum 640 credit score on an FHA loan, 680 on a conventional loan. If you qualify under the low-income housing program, it's a minimum 660 for a conventional loan. Now, there's, with a debt to income ratio, there's maximum requirements of 45%. And I'm going to show you the income qualifications outside of the forgivable loan in just a second. Now, what's nice about this program, it looks at only applicant income. So if we're married, and let's say, for example, I make $150,000 a year and my spouse makes $150,000 a year, but our combined income takes us over the income limit. If I apply in just my name, that's the only income that's considered for the qualifying. So that's a really great aspect of the program. And believe it or not, a first-time home buyer is someone that hasn't owned in the last 3 years. So I was just talking to a client this morning. He's owned a rental property in Texas for the last 4 or 5 years, I believe, but he's rented here in California for the last 3 years. So because he's rented for the last 3 years, he's still considered a first-time buyer. So these are the income limits by county in the greater Bay Area. So you guys can see all the numbers there. What's different with this assistance program versus some of the other programs that are available, like the AC program in Alameda County, is those are based upon much lower income limits. Usually they're going to be based upon either the median income level or that 80% median, 80% of the median income level. Okay. again, if you have any questions, feel free to chime in. We'll make sure we get those answered live on the workshop. So, okay, so that's a little bit about the CalHFA program. Hopefully that was exciting information for you. What I found in teaching this class, CalHFA is really a big eye opener for a lot of first-time homebuyers that didn't think homeownership was within reach. So as we kind of move towards the path towards during that path towards homeownership, I want to talk to you a little bit about the buying process. What does it look like? This is our 6 steps of home buying. I'm going to walk you through these milestones so you can have an understanding of what it looks like to move from, I learned a little bit out this workshop. Now I've done a consultation and now I'm ready to get pre-approved. So once we get pre-approved for our home purchase, that kind of sets us on this path towards home ownership. So the first step is pre-approval. What a pre-approval says is it's a certificate to the seller that basically says that you're eligible for your financing. And it kind of outlines your purchase price, your down payment, the loan program. So a seller knows that you're fully qualified. With a pre-approval, we've looked at your income, your credit, your assets. Everything is packaged up as part of your home buying game plan. Usually the pre-approval is good for 60 days, but if your home buying journey takes a little bit longer, we can always recertify the pre-approval at any time. Now, the pre-approval is the output of a consultation. I'm going to talk to you a little bit more about what a consultation looks like. And we'll kind of share with more kind of the framework of it in just a second. So after we get pre-approved, that'll set us off onto the next milestone, which is house hunting. So generally, you're going to want to partner with a realtor that's an expert in the market that'll help you with, obviously finding the right house, negotiating a price, terms of the contract. And we do have a fantastic network of preferred realtors in the Bay Area that can help service you in your home buying needs. These are just realtors that we've trusted throughout the years, creating a great client experience for our customers. Now, as you go throughout the market, and you may get pre-approved at one level, but maybe you need us to amend your pre-approval, we can always update that pre-approval letter to match your offer prices. So there can be different iterations of pre-approval amounts. Now, let's say we make an offer on a house and the offer gets accepted. Then we're going to move to step 3, and that's called entering escrow. So that means the seller has accepted the offer to our house. And that's obviously a big celebration because that's kind of half the battle, is just trying to get an accepted offer. Within 24 hours of that acceptance, I'm going to give you a call and say congratulations, and we're going to schedule you for a follow-up consultation where we get a chance to kind of design your financing together with you on video, make sure you understand the interest rate offering that's available to you, monthly payments, out-of-pocket expense, and we'll walk through the buying process again, just to make sure you feel comfortable with all the setup of your financing. Within 2 to 3 days of that acceptance, you'll be required to make an earnest money deposit. That's usually 1 to 2% of your purchase price. And so, like I said, we're going to do a follow-up call with you within a few days of your accepted offer. Now, that also starts the clock when it comes to inspections and appraisals. We're in charge of ordering the appraisal. Your realtor will order the inspections. And so I'll talk to you a little bit about timelines on that in just a bit. And then after we finish up that final follow-up consultation, we're going to issue to you your initial disclosures that highlight your interest rate, your payment, all your out-of-pocket expense. Now, your earnest money deposit is required within 2 to 3 days of your accepted offer. And like I said, that's usually 1 to 2% of your purchase price. Those funds go towards your total out-of-pocket expense. And generally, that deposit is protected within your contingency period. Now, for those of you that are going to purchase in the Bay Area is a little bit different from a contingency perspective. And because a lot of sellers are looking for buyers to kind of be a little bit more all in on the purchase contract, and in some cases waive some of these contingencies. But these contingencies protect you and your deposit in the transaction so you can do your due diligence. So some buyers in the Bay Area, because it is very competitive, are waiving their appraisals or inspections or loan contingencies. But we want to be cautious with that. And you want to talk to your real estate professional if that's kind of in your best interest to do that. Because the appraisal contingency ensures that you're not going to move forward in this purchase unless the house appraises for what you're buying it for. Your inspection contingency allows you to do your due diligence on inspections for the house, home inspections, pool inspections, roof inspections, whatever you think you need to do to feel comfortable about the property. And then the loan contingency ensures that you have your loan approval. And that contingency timeline is usually in the first 14 to 17 days of your contract. So if something doesn't turn out quite right, and maybe the seller's not willing to renegotiate some repairs to the property, you as a buyer have the opportunity to be able to exit that contract and still get a full refund of your deposit. So it's really important to be able to kind of protect that investment you've made into the property. Step 4 in the process is going to be processing and underwriting. And so that's where we're going to be doing some of the administrative tasks on the financing. We're going to verify your employment, like you heard about earlier, verify your assets. Just make sure all the documentation is prepped properly. Your interest rate will be locked by that time, especially in this volatile market. We really want to try to lock in that interest rate right away. And then we'll submit everything to our underwriters who will issue a loan approval. And once that loan approval is issued, there may be some follow-up items that you might need to gather for our team to be able to move to the final milestone, but it's a pretty easy process to get to the loan approval stage. Now, once we're there, we're also going to probably be at the end of our contingency timeline. So if the output of your inspections look great, the appraisal comes in to support the purchase price of the home, and we have your loan approved, then you're going to sign off on the contingency. So that's going to tell the seller that you're okay to move to the final stages of the home buying process. Now, on the lending side, we're going to issue to you a final closing disclosure. It's going to give you a 3-day cooling off period before we get to the very final stage and the very final milestone called closing your loan. And that's where we sign final documents in person with the public notary. That process will take about an hour, maybe an hour and a half or so. That's going to be all the final terms of your loan. There should be no surprises by the time you get to that point, because when we look back at our milestones, we've received 3, maybe 4 different disclosures that highlight all the financing structure. So you'll have a good idea of what it looks like before you get there. After you've completed the signing, then you're going to wire in any additional funds that are owed for you in the transaction. Those funds get reconciled by the escrow officer. So it basically shows that you've contributed what you're supposed to as the buyer. On the lending side, we complete one more audit of your loan to make sure all the signatures are done correctly, and then we wire in the funds for your mortgage. After that money is reconciled by the escrow officer, then they will record documents with the county recorder's office. So if you're buying in Santa Clara County, there's a Santa Clara County recorder's office. They'll record a grant deed that transfers ownership to you. And then they'll also record a deed of trust, which is your agreement to repay the loan. And so after the escrow officer gets the confirmation of those recordings, then you become the official owner of the property. So that's when you get your keys to your house, be able to high five your realtor and say, hey, we did it. And it's a huge accomplishment, obviously, right? You got a chance to be able to make that huge purchase. And it's a big deal. We want to help celebrate that with you as well, making it to that milestone. Again, all this material we'll be sending to you so you have a copy of it as a resource for you during your home search. Okay, so I want to talk to you a little bit about kind of what it looks like moving forward in the process. You've heard me talk a little bit about consultations, and what a consultation is, allowing us to meet with you over video or maybe over a phone. Video is a little bit better because we'll spend 30 to 45 minutes kind of developing a home buying game plan. In advance of that, you would submit an online application. We would do a soft credit pull for you so that doesn't impact your credit score. And you would also upload income and asset proof. We'll take that documentation, review everything, and we'll go through that comprehensive plan as part of your consultation. Like I said, that consultation usually takes about 30 to 45 minutes. And allows you to be able to walk away from that consultation really having a clear vision of what it looks like for home buying, and then most importantly have your pre-approval so you can move on to step 2 in the process. Now, after today's workshop, if you maybe just have some follow-up questions that didn't get answered for you, love to be able to connect with you for an intro call too. That's like a 10 to 15 minute session where you can maybe want to go through your personal situation of, you know, how you want to design your finances, or maybe a credit question. And then hopefully after that call, you like to take the next steps towards scheduling a consultation. Now, a consultation is a free service we provide just to provide that game plan. It's not anything of a commitment where you have to go out and find a house right away. We just want to be a partner for you and help educate you in the process of what it could look like to one day be a homeowner. Here's the framework of a consultation. So it's looking at budgeting, the game plan, process, looking at affordability. We'll do an application review, talk about interest rates. We'll even look at the interest rate climate. I do a lot of kind of sharing of kind of what interest rates have done as part of that consultation. A little bit more kind of granular than what we saw here in the workshop. And then, like I said, the output of the consultation will be to issue your pre-approval letter. One of our resources that I think is a great tool for you, I mentioned a little bit about the calculator earlier, is our mobile app. You can download it right here. It's good for Android and Apple. You can kind of follow the progress of your loan through mobile. So it's just a great tool to be kind of a support for you during or resource for you during the process. Now, you may be joining tonight's workshop because of our great partnerships that we're really super proud of. Part of these partnerships, we have a $750 discount program. So when your financing gets all wrapped up and you're in the escrow phase of your home buying process, you get a $750 discount. And in essence, what that does is normally we have a $910 processing fee that drops down to $160 with our various partnerships through our alumni. If you're a state employee, that discount also holds for $750. So that's a little bit about some of those partnerships. Now, as you heard earlier, we teach workshops about once a week, basically, and they're in different markets. Here's some of our upcoming workshops. In a couple of weeks, we're going to be teaching for our Orange County class, and believe it or not, we do one for Virginia. We have a partnership with Virginia Commonwealth, but we're primarily doing our workshops for California. So if you do have friends, family, maybe coworkers that would love to kind of hear some of this content, they can always attend a free class at mortgageeducate.com. If you even want to join another class, we'd love to be able to have you back in if you want to just learn a little bit more and do maybe a little bit of a tune-up. Here's all my contact information, my email, my direct cell. If you want to message me, more than happy to answer any questions for you. If you want to schedule one of those intro calls, maybe get scheduled with a consultation, feel free to schedule an appointment right here. And finally, we love to celebrate homeownership. I can't tell you how many graduates we have from our classes that we've taught the last 7 years, what they're saying about their experience with American Pacific in their home buying process. So please check out some of our fantastic reviews on Google and Yelp. We're really proud of that. And again, speaking of celebration of homeownership, if you check out some of our social channels on Instagram or Facebook, we're always posting about some of the great things that we see in clients getting their keys to their house and celebration and whatnot. We're also trying to post some great resources for you on our social channels. So we encourage you to follow us on Facebook or Instagram, because we always try to post out some good information. In fact, the launch of the Equity Builder program went out to our social channels last week. We'll have some great things coming out to you this Friday as well. So with that said, I know we've kind of moved through our content pretty quick tonight. We didn't have as many questions as we thought, but we do want to hang tight for any Q&A that you guys want to throw out to us, make sure we can share those with the group live on air. As a reminder too, while we're waiting for any type of questions, we are going to send all this material out to you tomorrow morning, so you can have that, and hopefully that'll be a great resource for you. And you know, if you do decide to do a consultation with us, we'd love to be able to kind of go back through that information with you as well. Okay. All right. So I'm going to stay on air for a couple minutes. I'm just going to shut down my video and mute out, but I'll come back in to wrap us up and if we have any questions. Okay, it looks like we're good on questions for tonight. If it's something that you didn't get a chance to answer or ask us, I should say, on tonight's call, feel free to reach back out to us. We're more than happy to get that answer for you. I want to thank all of you for spending your Wednesday evening with us. You know, we really appreciate the opportunity to be able to share this information with all of you. If you do have any questions, please feel free to reach out to us, and we look forward to hopefully connecting with you soon. Have a good evening.